Did you know that the global stock market is worth over $100 trillion? That's more than the GDP of the entire world. In this video, I'll show you how you can get a piece of this pie by learning the basics of the stock market. But before we get started, give this video a like and hit the subscribe button so you can stay informed about our next video coming the next days about technical analysis. It's free but super helpful for me. Thank you, and let's continue. And the question now is, what exactly is the stock market? Let's begin with a simple analogy. Imagine you want to start a lemonade stand, but you lack the funds for ingredients and equipment. So, you decide to ask your friends and family to invest in your business. In return, you give them a share of your lemonade stand. Now, they own a part of your business and can benefit from your profits. This is essentially what the stock market is, a place where people can buy and sell shares of businesses. That leads to a second question. How does the stock market exactly work? Let's take a real-world example to understand how the stock market operates. Consider Apple, one of the most valuable companies globally. As of today, the beginning of 2024, one share of Apple costs $187. This means you need to pay $187 to own a tiny piece of Apple. The price of Apple's share changes daily based on market supply and demand. Buying low and selling high or holding onto your share and receiving dividends can help you make money. Now let's walk through a simple trade scenario. Suppose you decide to buy a share of Apple at $185. If the price later rises to $195 and you decide to sell, you make a profit of $10 per share. This concept, buying low and selling high, is fundamental to making money in the stock market. On the flip side, what if the share price falls after you buy it? Let's say you purchase at $185, but due to market fluctuations or company news, the price drops to $175. If you decide to sell at this point, you incur a loss of $10 per share. An other trade scenario that can make you money as well is short selling. Short selling is like betting that a stock's price will go down. You borrow and sell the stock, planning to buy it back cheaper later. If you're right, you make money from the difference. But if the price goes up, you could lose a lot. Now let's say you decide to short sell a share of Apple at $180. If the price later falls to $170 and you decide to buy it back, or in simple words, close the trade, you make a profit of $10 per share. This is because you sold high and bought back at a lower price. However, if the price of the stock increases to $190 after you sold it at $180 and you decide to close the trade, you would indeed incur a loss of $10 per share. This is because you're buying back the stock at a higher price than what you sold it for. Understanding these scenarios is crucial because they highlight the risk and reward nature of investing. Prices can fluctuate based on various factors, and investors need to carefully analyze market trends and make informed decisions. Remember, investing always carries some level of risk, and it's essential to conduct thorough research and stay informed about the companies you invest in. In future videos, we'll get deeper into risk management strategies and ways to navigate the complexities of the market. Let's now explore market indices using charts. Take a look at the S&P 500. The S&P 500 tracks the performance of the 500 largest U.S. companies, and despite dips and crashes, the S&P 500 has steadily risen over the long term. For instance, over the last 10 years, from 2014 to 2023, the average annual return of the S&P 500 was an impressive 13.76%. This means that if someone invested $1,000 in the S&P 500 at the beginning of 2014 and reinvested all dividends, it would have grown to $3,729.7 by the end of 2023. Understanding the historical performance of market indices like the S&P 500 can provide valuable insights for investors. It emphasizes the potential for growth over time, showcasing how a long-term investment strategy in well-diversified indices can significantly increase the value of your initial investment. However, keep in mind that while indices like the S&P 500 can be a powerful tool for wealth accumulation, individual stocks can have different performances. Not all stocks are equal, and that's why diversifying your portfolio by investing in various stocks from different sectors and industries is crucial. Diversification helps manage risk and ensures that your investment isn't overly exposed to the performance of a single company or sector. Now, in order to get started in the stock market, you need a brokerage account. Think of it as a bank account for buying and selling stocks. Many online brokers offer low fees and easy access. I personally use eToro. It's a regulated broker that keeps your funds safe. It's super easy to use, has low fees and transparent pricing. It has thousands of trading options, from stocks, forex currencies, cryptocurrencies, indices, and more. It also provides copy trading, so until you learn how to trade on your own, you can copy the trades of other successful investors with one click. If you want to learn more or register for free, use the link in the description below. Here's how you can open an account and trade with eToro. Click the Join eToro button. Sign up using Google or Facebook, or just add your email, a username, and a password, and click Create Account. After that, you will need to fill out your personal information, verify your identity, fund your account, and once set up, you can trade stocks, indices, crypto, or anything else available using the trading platform. Log in, search for the stock, click Trade, choose if you want to buy or sell, enter how much money you want to invest, and choose leverage times 1, especially if you are a new trader. Click Open Trade and wait for execution. Leverage is the use of borrowed money from a broker to trade more than your own capital. It can increase your profits or losses depending on the market movements. For example, by choosing leverage times 1, if you invest $10, then you have $10 invested in total. With leverage times 2, if you invest $10, then you have $20 invested in total. $10 times 2 equals 20. With leverage times 5, if you invest $10, then you have $50 invested in total. $10 times 5 equals 50. It sounds too good to be true, but it's not. And you can lose your initial $10 2 times faster with leverage times 2 or 5 times faster with leverage times 5. So I would strongly advise you to start with leverage times 1. Anyway, after you open your trade, the trading platform also lets you monitor your portfolio and performance. Now let's talk about bull versus bear markets. Markets go through distinct phases, characterized as either bull or bear markets. A bull market is optimistic and confident, marked by rising prices, as seen in the period from 2009 to 2020. Conversely, a bear market is characterized by pessimism and fear, leading to falling prices, such as the downturn observed during the 2020 COVID-19 pandemic or the 2008 Great Financial Crisis. Technically, a bear market is officially declared when a stock, index, or any other asset declined by 20% or more from their recent peak. Conversely, an exit from the bear market and entry into a bull market occurs when the same asset rises by 20% or more from its recent low. To illustrate, let's take a closer look at the charts. On February 19, 2020, the S&P 500 index reached its all-time high at 3,393. After just 16 trading days, it experienced a 22.47% decline, officially entering the bear market phase. The lowest point was reached on March 23, 2020, and remarkably, by April 6, 2020, it had risen by 21.53%, marking a swift transition into a bull market. The fast exit of the bear market in the COVID period was attributed to the substantial liquidity injected into the markets by the Federal Reserve. Massive amounts of money were printed and infused into the markets, resulting in a rapid recovery. In opposition to 2008 Great Financial Crisis, it took 39 weeks for the market to decline by over 20%, entering the bear market from October 8, 2007 to July 7, 2008, and hitting the bottom on March 2, 2009, around 34 weeks of bear market. After the bear market, it only took 3 weeks for the market to turn around and start a bull market. This shift began on March 23, 2009. Understanding these market phases is crucial for adjusting your investment strategy. In a bull market, consider focusing on growth stocks. Conversely, in a bear market, consider selling weaker stocks or exploring alternative strategies like short selling or hedging to safeguard your portfolio. In order to not make this video too big, we are not going to talk about short selling or hedging strategies, but we will do that soon. The platform I used for those charts is called TradingView. It's a cool free platform where you can check out stocks, indices, crypto, and more. You can analyze anything you want by using technical analysis. It's free to sign up, and I dropped a link down in the description if you want to give it a go. And that's it, an overview of the stock market basics. If you found this information valuable, don't forget to like and subscribe. Drop your questions in the comments, and stay tuned for our next video on market analysis, using technical tools on charts to decide whether we can buy a stock or not. Happy learning and happy investing.